Hi everyone. Today we will be overviewing one of construction models. So there are a lot of variations of construction financial models. Today we will be building houses. So if you find these tutorials and overviews valuable, please like, share and subscribe to our YouTube channel. So here we're showing some Power BI tutorials, and we are overviewing different types of financial models that are describing different types of businesses, scales of businesses. So if you're planning to start a new business or you have an operating business, so this channel will be valuable for you. So let's get started. So first of all, if you are building any model, any financial model, you need to highlight the inputs, because once your model will be ready, you will need to be able to easily find the inputs to play with them, to see how these inputs affect the cash flow statement, payback period and so on. So that's why you need to highlight the inputs for yourself to be able to find them easily, and for all the third parties like your business partners, bankers, anyone who's involved in your projects. So the first rule, we are highlighting the inputs. So these are the inputs. So in this case, the inputs are colored with blue. Other cells are formulas, so we're not touching them while scenario play. So this is the input, these are the inputs, these are the inputs. All of the cells contain formulas. So first of all, we're starting with specifying the first year of our financial projections. This is step number 1. So now we're moving to the next block of inputs, the pricing strategy. So we are specifying the selling price for each type of house that we're building. And then we are setting up the square footage of each type of house that we are building. So now we're moving to the investment stage. So here, from left to the right, we have the investment stage expenses period. So this is the house type that we are specifying here. This is what we are investing in during the investment stage, during the construction stage, and here we're specifying how much we invest. So this is the construction period, so we're assuming that the construction period lasts for 12 months, and here we're specifying how much we're investing in, what we're investing in. These are the investment stage expenses for this house type number 1. So once we set up the name for this type of house, it will appear here, and we will be specifying what we are investing in and how much we are investing in, and during the investment stage, during the construction stage. And the same story we are doing for each type of house that we have. So this is house type number 2, number 3, number 4, number 5, 6, 7, 8. Now we're moving to the way our customers, our typical customers, how they're gonna pay us. So here, from left to the right, we have the months since we start the construction. So this is the start of the construction, and from left to right we have 18 months when our customers can pay us. So this is and here it is the percentages of payments of customer inside the contract. So this means that our customer may not be paying us all at one time. So we may split the price. So we're going up. So we have this price, selling price of the house. So we're saying that this price, this may be split in different payments. So let's say the first payment is 30%, then on the 5th month of the construction works, the customer pays us 15%, then on the 7th month the customer pays us another 15%, and we have 18 months to allocate 100% of selling price. If we allocate more than 100%, we will get here the error. So here we need to allocate 100% of selling price inside these 18 months. So this will affect the cash flow statement, and this will be very interesting for you to see how much financing you will need in this scenario and that scenario, depending on how what will be the payments from the customers. This will be very interesting for you. So lots of entrepreneurs, they play with this block of inputs because they want to see how much financing they need, if the customers will start paying them earlier, or they will be paying them let's say after 18 months of construction, after starting the construction. So this will significantly affect the amount of financing that you will need to start. Then we're moving to the next and very important block of inputs. So this is the project management. So here in this column we are specifying what type of house we're going to build. So here we have in this menu we have 100 houses. So here in this column we can specify what type of house we are going to build. Then we can also specify, we can switch this particular house on and off from calculations from the cash flow statement, and see how the cash flow statement, payback period, and financing needed, and all the financial numbers will look like if we switch off this or that amount of houses from calculations. And here we're specifying when we start building each house. So we can play with the type of houses that we are going to build. We can switch them on and off from calculations. We can play with the moment when we start building each houses. So this is pretty flexible financial model, and we have 100 houses inside. Then we may have some management company. So this is the investment plan for the management company. Here we can specify what we are investing in for the for the management company, how much we are going to invest, and this green column illustrates us the first month when we start building the first house. So this column is being generated automatically, and from this moment to the past we are investing in management company. If we do have any investment plan for that, we are specifying what we are investing in and how much. The next block of inputs is devoted to the management company payroll. So here we specify the positions for the people that are working inside management company, the payroll per month for each person, and the amount of people on this position. Then the same story we have for the fixed cost for the management company. Here is the list for the management company's fixed costs, and then we can specify the dollar per month values for the expenses for the fixed costs. Then we have two investment plans. The first investment plan is not linked to the moment when we start building the first house, so we may so here we can specify what we are investing in, price per unit, how much we buy the units, when we buy these units, year and month. Then we specify if there's any depreciation status, yes or no for this item, how long the depreciation period will be. So this is the first investment plan. If we do have any investment stage expenses that are not linked to the moment when we start building the first house, we can specify it here. And also we have investment stage expenses that are directly linked to the moment when we start building the first house. So this green column is being set up automatically depending on what month and year we specify here. So once we specify what houses and when we start building, so then we have this month and year, and then the Excel starts counting months to the past, and here we can specify what we are investing in and how much. And this is the moment when we start building the first house. This is the first type of investment plan that is linked to the moment when we start building the first house. And this investment plan, so if we don't have any investment stage expenses that are linked to the moment when we start building the first house. We can specify it here, so we can specify what we are investing in, how much, when we investing in, do we have any depreciation status, and what is the depreciation period. Then we're moving to the taxes. So we have several types of taxes. We can specify the percentages rates here. This is the type of the tax base for each tax. And then we're moving to the cash flow statement. Here it is. So these are the revenues. So we can press plus button and see the details for each type of house that we're going to build. We have the revenues. We can hide it. So these are the revenues, payroll, fixed cost, direct cost, taxes, the result from operating activity, financing activity. Here we can see how much financing needed. So let's assume we have a $5 million loan plus we need $19 million of equity. So this amount is being calculated automatically. Then we specify the discount rate for this specific scenario. Then we have the financial efficiency, the main financial numbers like simple, discounted payback period, profitability index, and so on. So this is where we're shown how much financing we need. So here we have several loans that we can add to our project. Here we can specify the amount of loan, when we get this loan, year and month. Then we can specify the term of loan in months, interest rate. If you have any grace period for principal payments or for interest payments, in months, we can specify it here. So all these loans will be presented here. So we can press plus button and see all these loans here. The principal, the inflow, the outflow for the loans will be shown here. And then we can see different charts, simple, discounted payback period, and so on. Here cash flow statement and P&L statement presented yearly. And then we have several yellow tabs with sensitivity analysis. So if we are finished, if we're done with some scenarios and we would like to test it, how flexible it is, how stable it is, so we can play with, so 100% here will be the current values for financial efficiency for this scenario. And then we can increase or decrease. For example, this sensitivity analysis is built for the revenue. So what will happen with financial efficiency numbers if we increase the revenue by 15%, 30%, 45%, 60%, and what will happen if we decrease the revenues by 15%, 30%, 45%, and so on. So the pace of changing of this parameter we can specify here, so we can play with this. At this moment we can see that the interval is 10%. We can do it by 20%. Let's say 15%. All we want to do, so we just need to press sensitivity button, and we will be able to see how financial numbers will change for this specific scenario if we increase or decrease the revenues with the step of 15%. The same story, we can increase or decrease the payroll. So you can quickly test the flexibility and stability of your current scenario. So here you can play with the inputs. So you are playing with the inputs, then you go to the sensitivity analysis tab and see, for example, how the project, this current scenario, copes with, for example, if you increase or decrease fixed cost by 15%, so 15, 30%, 45, then you press the sense button and you will be able to see how stable your business idea is. The same story with direct costs. Then we also may test your current scenario, what will happen if investment stage expenses will grow or decrease. Then the same story for the interest rates for the loans that we are gonna get, if we have any. And this sensitivity analysis tab is for the interest rate, and this sensitivity analysis tab for the amount of loan. So usually when financial model is done, the entrepreneurs and future business owners, they start playing with all these numbers. So they are playing with the pricing, they are playing with investment stage expenses for different types of houses, they are playing with the way customers are paying, because it significantly affects the cash flow statement. So imagine, so if you start building the house and you already got 100% of the price, asking price for this house, so you can build it using the inflow of the customers' money, or you will be building all the houses using only your funds or loans, and somewhere in the future, on the 15th month or 18th month, you will be getting the revenue selling this house. So this will be completely different scenario, and this model can show you the difference between financing needed in this scenario, that scenario, optimistic scenario, pessimistic scenario. So usually entrepreneurs are playing a lot with the types of houses that they're gonna build. They are switching them on and off from calculations and see how the project is breathing with or without this or that types of house. Maybe you're too optimistic and you need to switch it off and see how the cash flow statement will look like in this particular scenario. Then they usually play a lot with the timing, the calendar start building of each house, because this also affects the cash flow, how much financing you will need. And then investment stage expenses for the management company. So all these parameters are widely tested by people who's gonna start this type of business. So they are adjusting the inputs, then they go to the sensitivity analysis tabs, pressing this button and see when the numbers go red, when the numbers go negative, and see how flexible this or that scenario. So I hope you enjoyed this model. We have more than 400 financial models, so we'll be posting them on this YouTube channel. If you find these overviews valuable, please like, share, and subscribe to our YouTube channel. Also, we are posting some Power BI tutorials for the people who already have the business. We're showing how you can migrate from Excel to the Power BI dashboards. So here on this channel you will be able to find these two types of tutorials. So thanks for watching, see you in next videos and tutorials, and bye.